Thank you.
So thank you very much for this introduction. Thank you very much for having invited me to talk here today. I must say I'm very honored on one side to be a keynote speaker. It always sounds good on your vitae. We just talked about vitae. But I was also very hesitant when Menachem approached me and said, could you give a talk? And although I started my career in derivatives, I then switched to risk management. I was running a big grant on risk management in all areas, so model risk, liquidity risk, market risk. For many years I also have been a bank regulator, but maybe growing old I start to also feel interested and sort of devote some energy and some time to understand what drives people's behavior in financial markets and understanding financial decision making. So I'll try to convince you at the end, so for those who stick until the end, that some of the research we're doing is maybe useful to the broad topic of risk management, but I think more specifically about the topic of operational risks, where the biggest source of operational risks is, of course, human failure. So that's something we're trying to study when we study honesty. So first, to be honest to my co-authors, I would like to say that this is joint work. Everything I'm going to be talking here, maybe they're to blame as much as I am. It's joint work done with Carmen Tanner, who's a psychologist at the University of Zurich, and Alexander Wagner, who's a professor of finance at the University of Zurich. So in a nutshell, what we're trying to do is to understand what drives people to behave honestly in financial settings, and respectively, what drives them to behave dishonestly. And the question is, first of all, why should we care about honesty in financial decision-making? And I like to start this talk, so it's a mixture of research and some philosophical thoughts by a quote by Mark Twain, who was a famous writer and humorist of the 19th century. Honesty is the best policy when there's money in it. We know that in finance there's a lot of money in it all the time, yet that's not always what we see when we read the FT or any other newspaper. So there's a second quote that was done by Goldman Sachs in its ethical code of conduct right after the subprime crisis. This is just after Goldman Sachs had bought some rotten mortgages from Paulson, had packaged them and had sold them back as in the denomination of the abacus CDO to its clients without any wording about the rotten feature of these packaged CDOs. So what are the motivations? So I would say there's a bright side and there's a not so bright side. So on the bright side, there's been a literature in economics, and I'm going to refer to a literature in finance, but also a literature in economics, which over the 10 last years has puzzled to the following question: why do people often behave more honestly than we would expect under standard economic models? And what I mean by that, these are mainly models where you try to maximize the expected utility of wealth, thinking about a rational human being who always takes his decision very rationally. On the other side, understanding the sources of honesty is important because it can help you to prevent sources of misconduct within corporation. And let me give a few examples to try to justify the validity of what we're doing. If you have read the press over the last 5 or 10 years, there's first of all the rock trader scandals. We had one at UBS, there was Jérôme Carriel at Société Générale, there was the whale trader at JP Morgan, which lost 6.2 billion. If you think about the subprime crisis more broadly, there was also this idea that a lot of people have sold toxic products, subprime mortgages, to people who didn't have the means of understanding the risks of these contracts. So you had these ninja subprime loans, no income, no job, no assets, but you got a mortgage nevertheless. And if you look more recently, we had, I come from Switzerland, so I'll talk about all the tax evasion scandals, but I can also talk about, for instance, the LIBOR manipulation rate or the exchange rate manipulation by a lot of financial institutions that I will not quote here. So what are we trying to do in this study? So we conduct an earnings management experiment, and I'm going to describe the experiment to you in great detail. So it's a very concrete setting. We put our students in the shoe of a CEO, and I'll explain later what the CEO has to do. And we try to identify sources of a dishonesty by doing two things: changing situational social norms and measuring individual characteristics, mostly what we call their ethical types. So why should we care about social norm? First of all, what is a social norm? Well, a social norm is something that describes the behavior that meets society's approval or disapproval. And social norms have been there across times and across cultures. They tell us how to eat, how to salute, how to applaud or not applaud in a situation. And I would say that if you take the corporate governance or the code of conduct of a corporation, it could be seen as a portfolio of social norms that tells people how they should behave in this corporation. So we're going to be focusing mostly on what we call, psychologists have called injunctive social norms. These are prescriptions that tell you what you should do and what you should not do, as opposed to what we call descriptive norms. A descriptive norm is much weaker. For instance, a descriptive norm would be, I tell you that 70% of your neighbors recycle their garbage. So the norms we have in mind are situational. They're very short-lived as opposed to really embedded in a given culture. So what are the main findings? And this may sound abstract, it's going to be clearer in a minute as I dive into the model and then into the experiment. So we have two main contributions. First of all, we identify which characteristic explain that some people resist social norms, and we'll see why this is important in the corporate setting. And we obtain information about what drives people to behave honestly by interacting their ethical characteristics with the social norms. And for those of you who would be interested by what we do, I just give the name of the working paper. It's available on SSRN and on the CEPR working paper series. And just to set our results in a specific context, overall, the bulk of evidence that I'm going to be presenting to you is consistent with a model of self-signaling under situational pressure. In other words, these people behave honestly to self-signal. What does it mean, self-signal? It's a bit schizophrenic. It means people are a little bit uncertain about their types, and they behave in a certain way according to time in order to validate their types or to be truthful to their types. Okay, so just the experiment in a nutshell. So I said it's an earnings management experiment where we place the participants in the shoe of a CEO who has a simple decision to make. He has to announce the earnings per share for the next quarter, and either he announces the true EPS, earnings per share, if we can say that the true earnings per share exists, or he manages the earnings, he announces a slightly higher earnings per share. Why would he do that? Because if the earnings per share goes up, the stock price goes up, his variable compensation goes up. In such a setting, in standard finance models, everybody should manage the earnings because it maximizes your expected utility of your compensation at the end of the day. And yet that's not what we find, and I'll show you exactly what we find. So the importance of social norms and conformity has been recognized in the literature, not by us, but by psychologists and sociologists before us. What we do is we place one set of participants before an earnings management approving norm, and I will show you how we do that, and one set with a disapproving social norm. So you could think about a bad norm and a good norm, and we look at what they do. And I told you we look at people's characteristics or their ethical types. And I'm just going to take your, sorry. So what we mean by ethical types, we call them the ACOL, or the agent-specific cost of lying, and maybe just a slide on what are ethical values. I know we all know about ethics, I just wanted to give a simple definition. These are rules that define which behavior are morally right or wrong, so I will give you some example: justice, responsibility, honesty in our case. I will focus on a specific subset of ethical values which are called protected values. And you could think about them as lexicographic preferences, in the sense that protected values are certain values which are seen as absolute. So people are unwilling to trade off these values against monetary benefits. So they're non-tradable, and people will resist engaging into a trade-off between these ethical values and their benefits. Sorry. Oops. Sorry. Okay, so we have 3 scales that measure your types. Of course, this is not perfect, but we use them. So the first scale is called PVT-RV, for protected value for truthfulness with reaction to violations of honesty. So that measures people's emotional reaction. How do you feel if somebody violates honesty? The second scale is a more cognitive scale. It's called protected value for truthfulness, no trade. So this is how you view, or how you would be willing to trade off honesty versus some higher bonuses, for instance. And the third scale is very well known in economics. It measures people's pro-social concerns. In other words, how much do they care about other people. Okay, so just a few words. This is a literature that's very far from risk management, just for those of you who would be interested in pursuing this line of research. We are related to 3 main strands of literature. First of all, as I told you in the beginning, there's a literature that has emerged in the last 10 years that tries to understand or to emphasize that people have extended preferences. And in particular, they have moral preferences, and they incur that, therefore, intrinsic lying costs. So in this literature, you have work by Gnisi, Erat and Gnisi. We had a paper in the AER in 2013, so there's been several papers that have actually evidence that people have intrinsic preferences for truthfulness. The second literature is on the role of social norms. So first of all, in psychology and sociology, what people have found is a very basic principle: we all behave like sheep. In other words, if you're in front of a good norm, you're going to follow the good norm. If you're in the front of a bad norm, you're going to tend to conform to the bad norm. However, more recently, what some economists have found, so that's the papers by Slivka, Fisher and Hatter, Burks and Kupka, is that there's a lot of heterogeneity. People don't all behave like sheep, and we want to understand what drives this heterogeneity in behavior. And finally, we relate to a third literature, which is on self-image concerns. So for instance, the paper by Mazar, Amir and Orgelli, where people were asked to report what results they did, for instance, on a math test, and whether they would cheat or not in reporting their results. And he finds that people actually tell the truth out of a self-image concern. And that's related closely, but not totally, to self-signaling models such as the one by Benabou and Tirol. However, the evidence in favor of self-signaling, so one paper by Grossman and van der Velde actually finds that in an experiment where people refrain to learn about their negative behavior is consistent with self-signaling. In the next paper that they wrote, they actually found no evidence of self-signaling, but strong evidence about signaling to others, which we call social signaling. Okay, so there's a few slides with some equations, but then I'll show you the experiment. So the self-signaling model that we're trying to test. So our agents have a type that we denote by theta, and there's a continuum of these types between theta lower bar and theta upper bar. And each of these individuals has what we call VISE, is his global utility. So global utility is defined in two states of nature. T equals 1 is when the individual tells the truth. T equals 0 is when he lies. So when he tells the truth, the first component is minus the extrinsic cost of telling the truth, minus exco, multiplied by 1 minus r theta I. And when r is positive, you could view this as a resistance to this extrinsic cost consequence of telling the truth. If r is negative, it amplifies this situation. The second component of the is the self-signaling term, eta zeta 1. So eta denotes the strength of your commitment to self-signaling, and zeta 1 is your posterior about your type after you have told the truth. So if you lie, basically you have a self-signaling component in the lying state, and you have minus v theta I, which are the costs of the moral costs of lying that have been recognized in the literature. So what we do then is we equate the global utility in those two states of nature, which leads to a fixed point problem that we can solve under a uniform distribution, and we get what we call a separating equilibrium. So we get a cutoff rate theta hat, which is the type of the individual, such that above theta hat everybody would tell the truth, below theta hat everybody would lie. And a necessary condition to sustain that equilibrium is that R, what we call our resistance parameter, be strictly greater than minus V, which is the marginal value of truthfulness, divided by the extrinsic consequences of telling the truth. If V is low, the necessary condition boils down to R strictly positive. And that's exactly what we want. If the guy self-signals, he will resist the economic cost, or he will resist the social norm to signal that he's a good moral type. So that's what we're trying to test. So what we do next, and this is the last sort of slide before I tell you the hypothesis and how we do the experiment, is we take the difference in utility, YIC, between the truth-telling state and the lying state. And you see that it has three components: the moral costs of lying, the opportunity cost of telling the truth, which is the second component, and the third component, which is the self-signaling component. And if you actually decompose the extrinsic cost of telling the truth into the economic costs, which in our case would be the missed bonus, and the social norm-driven cost, which I called SN cost in the approving and disapproving norm case, you have expression 7, which in the first two lines actually tells you what are the direct effects of all the variables. So the direct effects, and I'm going to come to it in a minute, are what is the influence of ACOL, which is the type, what is the influence of the social norm-driven cost, the approving and the disapproving one, and what is the importance of the economic cost. And then the third and the fourth line give you the interaction terms between the type and the situational norm or the economic cost. And that's what we need to test our self-signaling model. So let me now become much more verbal and forget about the equations. So we test 4 hypotheses. The 3 first one are direct hypotheses, and they're pretty obvious. For that you don't need them all. So the first one just says that truthfulness is more attractive for higher ethical types. So that means that in the equation here I should expect VA to be strictly positive. The second hypothesis is based on the former literature on conformity, and it says simply that under a disapproving norm of earnings management, I should see truth-telling increase, and the opposite under an approving norm of earnings management, right? So, because people tend to conform. And the third one is called hypothesis incentive. It basically says that if the economic cost of telling the truth increase, the probability that somebody tells the truth will decrease. Okay, now the most interesting hypothesis for us is this one, which is related to our self-signaling model. What does it say? It says under self-signaling, an individual's responsiveness to, for instance, a situational norm or an economic cost depends on the premise that he can actually signal his true type by showing resistance to this specific economic cost or situational norm impact. So what does that mean? We test that by looking at the interaction terms here, the coefficient before the interaction of the type of the agent with the cost of the norms and the economic costs. And we want to see if the individual displays resistance when his type is higher, as our model would predict. So these hypotheses can actually be divided into 12 sub-hypotheses. And I'm going to just try to explain what I mean here. You have in these columns here, PVTRV, PVTNT, PSC, and the demographics. These are the types. And I'll show you why we introduced the demographics in a minute. And you have here, in the 3 columns here, the dishonesty approving norm, the dishonesty disapproving norm case, and the economic cost case. So take the first row. PVTRV was an individual who had protected values for truthfulness with emotional reactions to violations of honesty. Oops. So in this case, this individual can signal his type by resisting both norms and by resisting the economic cost. The same is true with an altruistic individual who has pro-social concerns. But what you see here is a little bit different, and that's interesting. That's a guy who has a cognitive response. He doesn't want to trade economic benefits for truthfulness. So in the case of both norms, you cannot signal here because there's no monetary benefits in our experiment. So the interaction coefficient should be 0, but it should be strictly positive when you have an economic cost. And the final type is really a robustness test of our model. It gives you the demographic types, so gender, age, whether you read the newspaper, whether you have financial literacy, all of this is known. So there's no way you can self-signal any of that. So we should find that the interaction term between the demographic types and the situational variables should be 0 for all the demographics if our model is validated by the data. Okay, so now we come to the fun part, which is the experiment, which is always, I mean, when you think about it after, it's always easier than before because you have to exclude many. So you have in the lab to really exclude all the other influences. But I'm going to show you in a few steps. How much more time do I have?
Yeah.
Okay, so I know lunch is standing before you and me, so I will try to be concise. So what is the experimental design? So we take students from the University of Zurich. As you see, we have roughly 50% economic students, 40% with a major in finance, in psychology, sorry, and 10% from other fields. And we have slightly more men than women. I can already tell you, gender plays no role in terms of how it affects honest behavior. I was disappointed, but that's the way it is. Okay, so each participant was actually assigned in the role of a CEO who has to make a very basic decision. Either he announces the true earnings per share, which is 31 cents per share, or he decides to manage the earnings and he announces 35 cents per share. Okay? And The experiment was done online, totally anonymous. That's very important in the experimental economics literature because you want to abstract from any influence that you may have on the participants. So anonymity is very important here. And then so the dependent variable is the truthful choice. It's a binary variable. Do you announce 31 or do you announce 35 cents per share? Pretty easy decision. So what are the dependent variables? So we first have the economic cost of telling the truth. I'm going to show you in a minute how we display that. We then have the two earnings management social norms, one that approves and one that disapproves of earnings management. We then have the proxies of the types, protected values of truthfulness with reaction to violations of honesty, protected values of truthfulness with non-tradability, more cognitive, and pro-social concern. And then we have a bunch of demographics where we look for gender, for field of studies, for age, and whether they read the newspaper, had some information about finance before, and so forth. So the experiment has four main parts. The first part that I'm interested that I'm going to be presenting to you is when we do the earnings management task, which we call the truth-telling task under the situational norm. We then conduct a belief and manipulation checks. That's very standard in this literature. You want to make sure that the participant understood the questions you asked and that they were not playing on their iPhone or doing something else. Because these days everybody does it, so you want to control for attention to the experiment. Then we have a distraction task. They had to solve some calculus, some simple additions and subtractions. Why do we do that? Because we want to create some time gap between when they do the task and when we measure their ethical types. So this is what we call a filler or a distraction task. So let me show you what this looks like. So they had 5 situations, and in every situation, which earnings do you announce? So the first situation, if you announce 31 cents per share, your compensation as a CEO will be 60,000. If you announce 35 cents per share, your compensation will be 300,000. So this is a very costly situation. And we vary this up to the last situation, which as you see is costless, right? They get the same amount whether they tell the truth or they lie. And in brackets, because I have a limited research budget, I cannot pay the students 300,000 per student, this is how much they actually get paid when they make the decision. And you see that they get paid less when they actually tell the truth. So they really, in the experiment, have an incentive to lie, right? If they want to maximize the payment within the experiment. Okay, now the social norm, we split our sample in 3 groups. There's a control group, which has no additional information. There's an earnings management approving social norm group. So this one is confronted with a norm that says, everybody manages the earnings. It's perfectly acceptable to do that. And then there's a second group which is confronted to exactly the opposite social norm, which says that this type of behavior meets with widespread societal disapproval. Right? So let's see what happens. So I'm going to first provide you some descriptive evidence, then I'm going to show you the results of the hypothesis that we test, and then I would like to go back a little bit if we have time and just give you some implications for corporate governance more generally within a corporation. So this first table is sort of interesting because what is interesting for us is phase 2 with the approving, disapproving norm control. These are the economic costs, and of course, as the economic cost increases, the percentage of people who tell the truth decreases. That's obvious, right? And across all the situations, you have a magic number of 33. I say magic number because in many experiments, what we found, what other people have found, is that 30% of people on average in this situation tend to tell the truth. But this is there's heterogeneity, and we're going to see it. First of all, when you apply the norm, so take here the median cost. If I am under no norm, there's this 33% magic number. If I have a disapproving norm, you see already that the percentage of people telling the truth increases to 55%. And if I apply a disapproving norm, an approving norm, it drops to 15%. So conformity with the norm, right? People are very malleable. But what's sort of interesting already, what we did here, and this is just descriptive evidence of our hypothesis diff response, we split people in terciles according to their protected values for truthfulness with reactions to violations of honesty. And you see that the bottom guys, let's say they are low ethical types, and the top third ones are high ethical guys. So what you see in the bottom part is that between the control group, the approving norm, and the disapproving norm, there's a great heterogeneity in terms of behavior. If you go now to the high tercile, you see that this discrepancy is much lower than here. In other words, people are much more resistant to the situation. They tend to resist both the approving and the disapproving norm, and I'm going to tell you why when we get closer to the end. So here what we do, and I'm going to just give you results for column 1. Column 1 means the 3 ethical types are not orthogonalized. So first you see that for each ethical type, as the type increases, the coefficient is strictly positive, so the percentage of truth-telling in these logit regressions will increase. These are very simple logit regressions. In other words, the dependent variable is just whether you tell the truthful choice. You see that under the approving norm, the coefficient is negative. That is consistent with hypothesis conform. Under the disapproving norm, the coefficient is statistically significant and positive, so people tend to tell the truth more. And of course, under the economic cost, they tend to lower their truthfulness responses. So all the direct hypotheses are corroborated by the data. But the most interesting hypothesis for us is hypothesis diff response. And the way we test this hypothesis is by looking at the interaction between the type and both norms and the economic cost. And you see, for instance, if I take, in the 3 columns, I have the 3 ethical types. If I take PVTRV, in the case of the approving norm, the coefficient is strictly positive, that shows resistance. In the case of the disapproving norm, it's negative, which shows resistance again. And in the case of the economic cost of telling the truth, it's positive, which shows resistance. The same is true for PSC. Unfortunately, the coefficient is not statistically significant for the resistance to the approving norm. It's 0.38, but with a 1.6 t-stat. And remember, for PVT and T, there was no signaling going on for the approving and the disapproving norm. So our coefficient should both be statistically insignificant, and that's exactly what we find. So it seems that the model is corroborated, and it's even more the case when I show you the results between the demographic variables, sex, age, economics, newspaper, and so forth, and the norms and the economic cost. In most cases, except 2, but this is not robust if you run some other specifications, you find that under the demographic variables, there's no self-signaling going on. Okay? So let me, I'm going to skip maybe the robustness. We did a bunch of robustness checks that I'm going to leave out here. And let me give you a summary of our results. So first of all, we conducted a simple, anonymous, non-strategic earnings management experiment with true incentives to lie. We test 4 hypotheses. The main one is this resistance to the situation, whether it's economic cost or situational norms, which seem to be largely supported by the data. What do you get from that? And I'm going to be more practical in a minute. But what you get from that, first of all, is that people are very heterogeneous. So in other words, you have the low types that don't resist, but you have the high types that very much resist both types of norms and the economic incentives to lie. What we find, the second powerful result, is that social norms crowd out the intrinsic preferences of the individuals. That means that they will resist the social norm, and the direct effect, the total effect of the direct norm, is lower than their direct effect. And why do people behave like this? Is consistent with a model of self-signaling under situational pressure. And why? What explains that, and this is a little bit a notion that refers to psychology and that's been also emphasized by many economists, this is driven by these high types control aversion. They don't want to be controlled, so they signal their types by resisting both norms. So we do a lot of other work, but I'm not going to. For instance, we repeat the experiment under stress or resource depletion. Why? Because most traders, most CEOs are actually under pressure. So we want to see what happens when people are under pressure. We also conduct the same earnings management experiment where we put people in an fMRI and we look at what brain region activate when they have to make moral choices. And I just am finishing conducting an experiment in the UK with some colleagues there where we look at what drives the trading patterns of investors who have signed the PRI Principles. So that means who care about the environmental, social, governmental principles, whether they're motivated by moral values or more by financial components. And why should this be interesting to you? First of all, we're almost done, so lunch is very soon to be here. But I think what we have to say is important in 3 dimensions. It's important for hiring decisions around this whole compensation debate that you have in financial institutions, and more broadly for corporate governance, the role of corporate governance and the role of regulation. So the first question is, should corporation hire, and what I mean here, PVs are people with high moral values. And this specifically at the top of the corporation. So there's many factors that speak in favor of that. These people resist external pressure, whether it's good or bad pressure, they resist it. They have more stable and predictable ways of behaving. And they're less tempted by financial incentives. So you may ask 2 questions, and that's what I get from, I presented these to many bankers, and they always say, well, can you measure this? I say, well, when you measure the IQ of somebody, it's also not a perfect measure, but my colleague is working on some skills that are quite robust in actually measuring the protected values of individuals. And the second question is, well, who would hire these guys at the top of corporations? Specifically, the management in place may fear that they're going to lose their situational rents, and thus there's a question as to whether these guys can really come and survive in a very competitive environment. But the second point that I think comes from this experimental study is that this whole CEO or traders compensation debate, in my view, misses the point. It misses the point because, as you see, there's great heterogeneity. Some people don't need to be incentivized or compensated only financially. They really care about control aversion and intrinsic motivation. And to the extent that you hire these type of people, the CEO compensation debate is not such a big debate anymore. So let me say, well, can honesty and other ethical values act as pillars for a better corporate governance? We think that the answer to this question is yes, but with a big but dots. Regulations remains important. Why? Because you saw that 33% of the people, 67 tend to still behave like opportunists, 33% tend to tell the truth, and this number increases even to 80% if you're in the presence of an earnings management approving norm, because we are very malleable. So if there's a bad apple, if there's a contagion in a corporation or in a business unit, there's a likelihood that most of us will face the contagion and will conform to the contagion. That's why you need regulation and you need strong corporate governance nevertheless. But what I think in terms of risk management and stability concerns, I think that what we can learn from experimental finance is to provide, that it provides some valuable insight into how traders, CEOs, anybody in a corporation makes financial decisions, what is the corporate risk culture, and how you can mitigate operational risks that stem from managerial misconduct. And I'm going to leave you with a little comic note. They said to think outside of the box. Naturally, I assumed box meant ropes. That's basically the end of it. And thank you very much for listening.
Thank you, Rajna. This is very interesting, insightful, but I'm sure some people have a couple of questions. We have room for a couple of questions, and I'm taking advantage of sitting here, so I have two questions. One, this was the one-shot experiment. To what extent, I'm sure you thought about it, to what extent would this be very different in the real life case where people think strategically and he says, no, I'm not going, I mean, in the longer run, this one shot is not going to pay, so I'm going to do, I mean, maybe honest or dishonest now, whatever it is, which eventually will going to come out, so I'm going to behave strategically, and maybe you get totally different results. That's one question. The other question is, to what extent, and this is, I don't know how you quantify and so on, there's an element called the fear of getting caught. Okay, whether it's the backdating story that we all know, or it's in the United States, you talk to people and say, I'm not going to lie on my taxes, you know? If I'm getting caught, I'm going to end up like Al Capone. But in other countries, it may be just pay some fine and that's the end of it. So to what extent does that figure into this honesty debate? Okay,
so to the first point, the strategic aspect, I think if you have a repetitive game, so on one side, repetition, it's like the sovereign borrower notion. Why should we lend to a sovereign in the first place? And in a repeated access to the market, one very strong disciplining mechanism is reputation. So I think that actually in a repeated game setting, the results should be stronger than in a one-shot game. But of course, that's something that we should test. Your second question is about penalties. We purposely decided not to have penalties because we wanted to see how just a norm, which is something very weak in our case, it's just you divide them into three groups, you tell one group this is good and you tell the other group this is bad, and already that has an influence in your behavior. So when you introduce punishment, and that's been shown in other experimental studies, you can actually reinforce the disciplining mechanism. But we wanted to see just with a very light touch, you can already sort of get quite interesting results in terms of conformity. But you can impose conformity much more strongly with punishment. So yes.
Yeah, I'm sure that this is the kind of topic, I'm sure there's going to be a lot of questions, but I want to finish in about a few minutes, so I'll allow like 3-4 questions. Yes, please. You, up here.
My question is the opposite of the penalty. Like, I mean, qualitative, the results make lots of sense. Like when you go from 0.3 to 1.5, it moves in the right direction. But are the results going to stay qualitatively the same if the stakes were higher?
Yeah, that's a very good point. You know, every time you want to publish a paper in this field, first of all, you can't publish in finance because finance is so far, the top journals are not interested in that type of topics. So you move to an economics journal, the first thing that comes to the table is whether the stakes are too low. Okay, so what some people have done is they've gone to India to conduct the experiments where you pay people in rupees, and then the research budget is much more significant and you can actually do it. So the next test, and that's why I talked about this experiment, this is what we're trying to do now, is to do with real professionals. What we do there, so first of all, from other literature, not my experiments, I can say that the evidence is quite strong. We have increased the stakes, actually, and we didn't find much difference. But of course, we haven't increased the stakes up to the level of, Vazela at Novartis earns, we can't pay 20 million or, so I don't know what happens when you go into these large zero figures. But what people have been trying to do now is to really get, and I think that's where we need to cooperate more with practice, is to conduct these with real professionals. These are called field experiments, right? And already what I can tell you is I've just seen the results for these professionals who claim they're ESG principle signatory, and we put them in a trading environment where they had to trade 5 stocks for 30 minutes. They behaved so aggressively and so competitively to earn the most money that I think all the moral principles were gone. It was really interesting to see how when you put people in a competitive setting, they forget about all the rest, sort of. It's sort of a... But these are just very preliminary.
But that's what self-select group.
Exactly.
Yes, please. Up here on my left.
One element when punishment was mentioned, the opposite of punishment is of course conviction. I mean, there are people who are just simply convinced that it is good to do the right things. And I don't know to which extent you have considered this, but another thing came to my mind when I saw this very interesting experiment. If you have people who are very resistant against, as you said, good or bad pressure from the outside, from norms, from punishments, from whatever, yeah, is there a relationship to some things like creativity, flexibility?
Yeah, okay, so that's a very good point. So first, when you said it comes from their good intention, that's absolutely the case. That's what we want to show, is that these people who have these strong principles, whether it's for honesty, some people may care about human rights, some people may be loyal, they will resist the external pressure. And the reason why they do that is a very old concept in economics, is when the extrinsic motivation, so for instance, if you want to pay them more to do a given task, they feel, in some sense, almost offended because it's their intrinsic motivation that counts. So that sort of answers a little, and it's due to control aversion. I don't like to be controlled in I know what I have to do, right? Don't tell me what to do. Basically, that's the story. But the second point about what you were saying is how does that affect their creativity? So one thing that we know is that these people, the downside is they're more rigid. So they're probably less open to change. So there's trade-offs that have to be made at this point in terms of hiring.
One more question. Yes, at the end there.
Maybe you talked about method, but did you analyze the correlation between the first and second answer of your test persons? So I would expect someone lying on the first question also to lie on the second question with a higher probability, and likewise for telling the truth. And is this also dependent on moral type?
I'm sorry, I didn't get the last part of the question.
And is this correlation between first and second answer also dependent?
Just turn the mic like this, it would work better, like this. Near to the
Is this correlation?
Yeah, is this correlation also dependent on moral type?
It's absolutely true. Yeah, that's exactly what we're trying to measure. It's how much it relates. So you have a big, so our first paper was about this heterogeneity, because what people have said in the past, there's a very well-known model in economics that said that people belong to two types. There's one type that is called the, let's say, the traditional economic Homo economicus that will always be opportunistic and always cheat in our experiment. And there would be one type that is called ethical that would always tell the truth. In fact, we see there's a big variation. But there are some people that behave like ayatollahs, that always tell the truth. They have absolute protected values. There's not many of them, but they are, in all the samples we have. So, but the key lesson is people are very heterogeneous. And that's why when you introduce a corporate governance code or a code of conduct or any kind of policy in a company, if you don't deal with that heterogeneity, you're going to be very disappointed because people have different reactions, right? Some will be more conforming, some will be more resistant to what you put in place, and so forth.